Hey, it's Mike over at Cross Country Mortgage. It's Monday morning, and it's time for your Monday morning mortgage update for the week of It's March the 17th. Happy St. Patty's Day. I hope you're all wearing your green. I'm representing this morning. We're going to talk about the market, what's going to happen on this lucky day today and the week, and what happened last week. Always try to give you insight about the market. So let's talk about last week. Last week, we saw a little bit of an increase to mortgage rates. The pricing went down. Over the last 2 weeks, we've actually seen a 25 basis point reduction in pricing, which means rates have gone up a little bit. If you're watching my Friday rate drop, it's a text I send out. It's a 60-second summary of what's happening with mortgage rates heading into the weekend. If you want to get on that text stream, just let me know. We'll put you on the list, and we send it out every Friday morning. So little bit of an increase in mortgage rates. What actually caused that? Inflation was at expectations, but it wasn't going down. So a little bit of a tick up in inflation. We know inflation is the death of mortgage rates. So if we see that inflation go up, and it's not going up as fast as it's gone up in the past, but everybody's just waiting for that inflation to start going down so that we can see mortgage rates improve. We also saw some recessionary fears. Is that coming? Now, a recession is actually good for mortgage rates, bad for the economy, good for mortgage rates. A recession is a natural cycle of our economy. They come and go, and we typically see better mortgage rates during a recession. Also, the probably the biggest thing that's affecting the market, or at least causing rates not to get better right now, is just the uncertainty. With Trump's economic policy, as I've said, we're really not going to see the impacts or the numbers on this for probably another month. But the whole tariff on off, and the unknown over in Ukraine with Russia, all of that is causing uncertainty, and people are pulling the money out of the bond market, but also out of the stock market. So that's why you're seeing both markets not really perform. Typically, we see a stock market get better when the bond market's doing worse, and vice versa. Okay, so what's happening this week? I always try to give you some insight. A big week for the Fed. The Fed's meeting, their second meeting of the year this week. They always start their meetings on Tuesday, and they end their meetings on Wednesday. And Wednesday afternoon, they come out with a press release. Jerome Powell, our Fed chairman, will talk to the media, give his insight about what they're going to do. Now, they're not going to cut rates at this meeting. Nobody expects that to happen. We do expect 3 rate cuts this year. The bond traders have really calculated that into their trading and their projections, but not this week. The other thing is about this Fed meeting is they're going to come out with economic projections. What do they think the economy is going to do for the remainder of the year? And they do this about every 2 or 3 meetings. They didn't do it last meeting. So a lot of attention will be paid to what Fed Chairman Jerome Powell says Wednesday afternoon with his economic projections. We don't expect any changes in policy. They really don't know what the Trump economic policy is going to do, because it really hasn't been set in stone yet. So again, just a lot of uncertainty. And when there's uncertainty, right now people are just pulling the money out of both markets. The second thing is central banks or world economy. 4 central banks are actually having their meetings this week too. China and Japan, we don't expect them to do any rate cuts on their equivalent of the Fed interest rate. And then the Bank of England and the Bank of Switzerland. Now, Switzerland isn't an economic power, but their central bank's pretty important in the world economy. We expect the Bank of England and the Swiss National Bank to actually cut their Fed fund rate, their equivalent of Fed fund rate. So we'll see how that impacts the market. Are people going to be pulling the money out of those economies and those markets and putting it in our bond market? And then the last thing is just a lot of data, really 2 big, important data coming out this week: retail sales and manufacturing. So we've got different retail sales reports this week. And basically, if we see weak retail sales, we had one report come out today, it wasn't very strong. That's a weaker economy. That means money should flow into the bond market. We could see better rates. We had manufacturing come out this morning. The Empire State Manufacturing in New York is really typically, nobody pays a lot of attention to this, but the numbers were so bad. Horrible manufacturing numbers, which means businesses aren't buying stuff to make stuff. The other component of that is they are paying a lot of money for stuff right now, a ton of money. A shocking number is some economists are coming out with this morning. They've never seen the amount paid this high. So What does that mean? If businesses are paying a lot, and this is just a snapshot of that region, is it going to then filter in to the other areas of the country this month as we start to see more manufacturing numbers come out for different regions of the country? And if businesses are paying more for stuff, that means that cost easily could be passed on the consumer. That's inflationary, and that's not good for mortgage rates. So we're seeing a little bit of an increase in mortgage rates today. This week, we're going to float. Hopefully, we get some luck of the Irish and we see rates improve. There's a lot of volatility expected this week, but we're floating into this week, really going to make some decisions on Wednesday. Hey, have a great, great Monday. Hope you have some luck today, luck of the Irish, and we'll talk to you next week. Bye-bye.